The tax planning domain represents approximately 14% and focuses on the role taxation plays in personal and business financial planning. Tax planning is essential because taxes directly affect investment returns, cash flow, retirement savings, estate transfers, and wealth accumulation. CFP professionals are expected to understand federal income tax laws, tax calculations, entity taxation, trust and estate taxation, and strategies for reducing tax liabilities legally and efficiently. Effective tax planning helps clients maximize after-tax income while remaining compliant with current regulations. This domain emphasizes integrating tax considerations into broader financial planning recommendations to improve long-term financial outcomes and support client financial objectives. Fundamental and current tax law provides the legal framework for understanding how taxation affects individuals, businesses, and financial transactions. CFP candidates must understand the structure of the federal income tax system, including filing statuses, taxable income calculations, marginal tax rates, deductions, exemptions, and tax credits. Financial planners must also remain informed about legislative updates and changing tax policies, because tax laws frequently evolve in response to economic and political conditions. Knowledge of current tax law enables professionals to recommend compliant and tax-efficient financial strategies. Understanding tax regulations is essential for helping clients avoid penalties, reduce unnecessary tax burdens, and make informed financial decisions that align with long-term planning goals. Income tax fundamentals and calculations are central to effective tax planning because they determine how much tax individuals and households owe each year. CFP professionals must understand gross income, adjusted gross income, taxable income, itemized deductions, standard deductions, and tax liability calculations. Candidates also study payroll taxes, alternative minimum tax considerations, and tax withholding systems. Financial planners use these calculations to evaluate how financial decisions affect after-tax cash flow and long-term wealth accumulation. Proper tax analysis allows planners to compare alternatives such as retirement account contributions, investment strategies, and compensation structures. Accurate tax calculations support informed recommendations and help clients optimize financial outcomes while complying with applicable tax regulations. The characteristics and income taxation of business entities are important because many clients own businesses or participate in entrepreneurial activities. CFP candidates must understand the tax treatment of sole proprietorships, partnerships, limited liability companies, S corporations, and C corporations. Each entity structure has different rules regarding income reporting, liability exposure, self-employment taxes, distributions, and deductions. Financial planners evaluate entity structures to help business owners improve tax efficiency, support succession planning, and align operations with long-term financial objectives. Understanding business taxation also helps planners coordinate personal and business financial planning strategies. Selecting the appropriate business structure can significantly affect taxation, cash flow, retirement planning opportunities, and overall business profitability. Income taxation of trusts and estates focuses on the tax treatment of wealth transfers, estate administration, and fiduciary arrangements. CFP professionals must understand how trusts and estates are taxed, including distributable net income, fiduciary income tax rules, estate tax calculations, and generation-skipping transfer tax considerations. Trusts are commonly used for asset protection, tax minimization, charitable giving, and intergenerational wealth transfer planning. Estate taxation also involves evaluating exemptions, deductions, portability rules, and liquidity needs. Financial planners coordinate with legal and tax professionals to design strategies that preserve family wealth while minimizing unnecessary taxes. Effective trust and estate tax planning helps clients achieve legacy goals and protect beneficiaries from avoidable financial burdens. Tax reduction and management techniques are key components of comprehensive financial planning because minimizing taxes can significantly improve long-term wealth accumulation. CFP professionals evaluate strategies such as tax loss harvesting, retirement plan contributions, income shifting, tax-efficient investing, Roth conversions, and timing of income recognition. Candidates must understand how different investment products and financial decisions affect taxable income and after-tax returns. Effective tax management requires balancing short-term tax savings with long-term financial objectives and regulatory compliance. Financial planners help clients structure transactions and investments in ways that maximize tax efficiency while supporting retirement planning, education funding, charitable giving, and estate planning strategies across different stages of life and economic conditions. Tax consequences of property transactions and special circumstances are also important areas within the tax planning domain. CFP candidates must understand the tax treatment of property sales, capital gains, depreciation recapture, like-kind exchanges, and investment real estate transactions. Tax planning also addresses special situations such as divorce, inheritance, stock options, expatriation, and casualty losses. These events often create complex tax implications that require careful analysis and strategic planning. Financial planners help clients understand how major financial decisions affect tax liabilities and future financial opportunities. Proper planning can reduce taxes, improve liquidity, and minimize financial disruption during significant life transitions or unusual financial events that require specialized tax consideration. Charitable and philanthropic contributions complete the tax planning domain by integrating personal values with financial and tax planning objectives. CFP professionals must understand the deductibility rules associated with charitable donations, donor-advised funds, charitable trusts, private foundations, and appreciated asset contributions. Strategic charitable planning can reduce taxable income, lower estate taxes, and support long-term philanthropic goals.